Hi everyone, and welcome to this week's edition of Macro Minutes, our weekly webinar. Today I'll be presenting this alone as the founder and managing director here at the firm, and we'll be doing things a little bit differently. But before I get into that, we'll just jump into the disclosure and the disclaimer. So everything that we discuss today, please understand that it is general advice in nature only and does not take into consideration your personal circumstances. What we'll do, so like I said, we're going to do things a little bit differently this week. Now, Maqro has been fortunate to be sort of featured on AusBiz quite regularly. We've got a fantastic relationship with the company since they sort of began, really, which is not too long ago. But to give you guys a little bit of light, so David Koch and Kylie Merritt are the founders of AusBiz TV, which is an online streaming channel. Now, it's Australia's largest business channel at the moment, with a fantastic or a significant number of users and audience, which is obviously fantastic for us to get our name out there. But Kylie was actually the CEO of Your Money, Your Call. And now what they've done is they've effectively replicated the same thematic of getting 10 companies from the audience to sort of be emailed in, and having two advisors or professional investment advisors to discuss those names and their insights. And so I'm just going to get the link to pop up on your screens now on your chat. And if you're watching this as a recording, just click on the email. There should be a button there which will direct you to the actual video. Now, it's an hour long, so just bear that in mind. But what we're going to do today is summarize that and take the three companies that we liked and the three companies that we didn't like and go into those in a bit more detail. So without further ado, let's go into the companies that we did like. So IAA, DTL, NST. I'm going to start with IAA. Now, this is the iShares Asia 50 ETF. It's an accumulate for us. Now, they are, so it's a basket of companies, 50 actually, from China, Hong Kong, Macau, Singapore, South Korea, and Taiwan. Now, China accounts for more than a third of the ETF. And so if we just kind of focus on that for now, and sort of give you a bit of light as to what our view on China is. So China was the strongest performing major economy in 2020. It was the only one to not go through a contraction. And obviously at the moment, you've got your tensions or your trade tensions between not only Australia, but also the US, as we all know now. Biden hasn't exactly or directly committed to thawing trade tensions, but he's definitely more open to it than, let's say, Trump. And his approach is hopefully going to be much more predictable and stable in nature. I mean, it'd be pretty impressive for him to be able to make things worse from here, let's face it. But that's going to make Chinese and Hong Kong companies much more attractive. Now, the largest holding in this ETF is Tencent Holdings. But the second two largest, respectively, are Samsung and Taiwan Semiconductors, which have both benefited from a significant increase in demand in semiconductors. And we expect that to be pretty strong into 2021. Now, Samsung continues to kick goals as well. They're developing new batteries for electric vehicles, which is obviously a very attractive space right now. And as a result, we do like this ETF. The only thing that we would sort of be watching out for is the price. Now, it's very expensive. It's experienced a phenomenal amount of growth in the last 12 months. And so investors, like anything, you want to buy it cheap, but you don't want to miss out. So it's, like I said, it's an accumulate for us, and we'd sort of be looking to accumulate as we start to see some weakness in the names. But another way that investors can take advantage of, I guess, this thematic is just looking at the underlying constituents. What are the stocks in these ETFs? What are the main ones that are moving the price? And if you invest in those directly because your portfolio is already diversified, well, you basically just get away with doing what this ETF does, but not pay the funds management fees that I think BlackRock that manage this will be charging. So that's our takeaway for that one. Data3. Now, Data3 is a company that's experienced a lot of benefit from the let's say COVID impact. Now, the impact that I'm specifically talking about is the need for companies to I guess, innovate and enter that digitization in their business model. So Data3 is in cloud computing and communications. They've got 6 major revenue segments: 61% in software solutions, 25% in infrastructure solutions, and 13% in project and support services. Obviously, again, it's been very strong during COVID, as you can see with the share price sort of accelerating when COVID hit. They boasted in August 18% revenue growth in the second half of FY20. Now, again, with the acceleration for the need of digitization, we've seen their guidance set at 8 to 9% growth in profit before tax. Now, just to touch on guidance, there weren't many companies that actually provided guidance this last year. Obviously, due to the high levels of uncertainty. And what we like about this business is that they're, obviously communicating that. Also, they've got a fantastic cash position, 255 million on their balance sheet to be specific. So we could see some strong dividends be paid out or further expansion. Our only negative sort of comment on Data3 is the valuations are a little too high. Price to earnings ratio sits at 37 times, which is above its average of the last 2 years of 30 times, and its global peers at 31 times. And again, I think what's really important for investors to know is that there have been a lot of companies, and we mentioned this in our last episode, there's been a lot of companies that experienced strong growth during COVID. And investors should be aware that things are going to, and already have, started to normalize. And so consumer demand is going to normalize. And considering the spike that we saw in working from home during COVID, it would be prudent to be aware that as we see more sort of news about vaccinations, better numbers in the Sydney region or just across Australia and the globe, naturally Data3, any companies that have had that beneficiary impact are going to be suffering or experiencing some profit taking at the least. And we've already sort of seen that during that November, December period. So moving on from that, next one is Northern Star. Northern Star was a hold for us, but nonetheless an interesting company. So merging with Saracen will make them one of the largest gold miners in the world. So investors should sort of be looking out for when that is all sort of taking place. The 2nd of February is a court date where they finalize the merger, and then it's the 3rd where it will actually sort of take place. The joint venture will be able to produce 1.6 million ounces annually straight away, which will put them on target reaching 2 million ounces in the near term. They'll have a gold reserve of 19 million ounces, and the Kalgoorlie Golden Mile will be, which is what they'll own. It will have the first owner. It'll be held by one owner for the first time in more than a century. And it's actually one of the richest gold fields in the world. And so naturally what we want to focus on is the gold thematic. Now, we expect prices to remain fairly elevated. It's still an attractive hedge. The US dollar remains low from stimulus, and the expected stimulus anyway, and there's low interest rates. This is all good for the price of gold, and as a result for the price of Northern Star. However, we have seen weaker than expected numbers in their NPAT in their December quarter, most likely due to the 3 months sort of consolidation that gold prices have experienced. And the gold production for the quarter was also weak. Whilst Pogo Mine, which is one of their mines, produced higher grade than expected in gold, COVID has resulted in development not being as fast as expected. So I think they had more than 100 cases. And so obviously just some concern there, but look out for those key dates for investors looking to take a position in this new JV. I don't think the name's out yet for the new entity, but take a look out for those key dates before you make a decision. Now, what we're going to do is move on to the underperformers. The ones that we're going to be talking about are Reject Shop or TRS, QBE or QBE Insurance, and then EHL Emeco. So we'll start with the Reject Shop. Now, the Reject Shop is everything discount essential goods. I remember back in my uni days, I'd go to Coles to pick up some 2-minute noodles and then head to the reject shop to buy some toilet paper. So really cheap and obviously discount prices. Now, they've done phenomenally during the COVID period. Strong balance sheet, 92 million versus 6.8 million previously. Good operating cash flows, normalized NPAT of 2.7 million in profit versus the loss of 16.9 million in the previous comparative year period. Obviously did quite well as the one-stop shop during COVID for a lot of your essential products, and that high consumer demand or spending, that we saw during through online sales during the lockdown and Christmas. Christmas, we saw national retail sales up 7.1%. So that was in the month of November, which has obviously been quite good for them, and the share price, as you can see. However, we thought that due to all of this good news, or I guess the circumstances that the reject shop was in, which was very unique compared to a lot of the other companies on the ASX, they should have been more aggressive on their strategic expansion, especially in a time like this. So if you look at their strategy when addressing the opportunity of COVID, the traditionally strong performing categories perform very poorly. So Easter-related products, luggage, obviously from the lack of travel, party, events. These are all products or revenue streams that they should have, from our opinion, been more aggressively diversifying away from. Now, they briefly mention this in their turnaround phase strategy in their outlook, but again, we think they could have been much more aggressive. We're likely to see a continuation as well. Again, the same thematic that we spoke about during for data 3 in the normalization in consumer behavior. And that's also supported by the ABS data showing retail sales in December 4.2% lower than November. So we're obviously seeing sort of people do normal things again as we move out of COVID, and that window for TRS to take advantage of things is closing quite aggressively. And so they could have bought more stores. Their rollout for new stores were actually quite low. CapEx in FY20 was low, which is their capital expenditure. Now, they could have bought a lot of distressed assets. Shopping centers were going cheap because of the skyrocketing vacancy rates and low interest rate environment. And Reject has a tremendous amount of cash, 92.5 million. They actually might be foregoing potentially their dividends. So all in all, it's a no from us. We want to lighten this one, but obviously, it has been benefiting from COVID. So that's why you can see that spike in May last year. Okay, QBE Insurance. So I've actually spoken on AusBiz about insurance companies a couple of times now. They seem to be an interesting thematic, but look, we get it. It's cheap. You take a look at the price chart here. It looks like there's a lot of value. That being said, it's cheap for a reason. Now, they've got a lot of short-term risks, still very much an issue for insurance companies right now. For example, low interest rates provide headwinds for any insurance business, and that's because it results in lower investment income. Usually these companies place their bets in fixed income, using all the premiums that they source from their customers. Now, again, although we're moving into that recovery theme, and you can sort of make a point or have the argument that, okay, well, Conrad, well, look at the price right now. I buy it here, and when things get better for insurance companies, surely I'll be better off. Well, sure, but are you taking into consideration the opportunity cost of how long that's going to take and what the further headwinds are? Now, they've been hit with a recent $55 million increase in the expected COVID impact, which is from their business disruption claims being higher than expected. So you're just going to have what we would say it's an asymmetric recovery. A symmetric recovery based on what's happening in the economy would be more closely aligned with, let's say, any company in copper. So OZL, for example, which I mentioned on the show as well, as a recovery play, the government or the economy is going to be focusing on creating jobs. And you create jobs by large infrastructure spending projects. And large infrastructure spending will be obviously utilizing raw materials like copper. And so for us, if you want a recovery play, you're looking to take advantage of discount prices and this recovery out of this recession of COVID. Look at OZL, look at the material space, look at names that are not just experiencing major headwinds due to the current environment that we still stand in, especially insurance, which is a little bit lagging. All right, now the last company we're going to touch on is EHL. We try to keep this nice and short for you guys so that we don't bore you. But EHL is an interesting one as well. It's the world's largest independent mining equipment rental business. They've got the largest fleet in Australia. And where they are diversifying their revenues by looking at different mining companies to contract with, which is always good. It means that they have less commodity specific risk. So they also have some really strong contracts. So Whitehaven, Saracen, Evolution Mining, just to name a few, and that's really good for resiliency, especially in this time. They also secured an open cut mining contract with Red 5, which is expected to help them see their 15% EBITDA growth in FY21. They also raised some money, so they're cash rich at $149 million through a 1 to 2.1 entitlement issue at 85 cents. And that's allowed them to pay off debt and provide their best balance sheet since their IPO in 2006. But the fact of the matter is that they are still heavily reliant on the coal industry. And so that's why we'd just be a little bit nervous about this one and sort of steer away until we get some more clarity on the diversification. And so China has put Australian coal on an unofficial blacklist. And there is a sense, and if anyone's seen, I highly recommend it, or seen or read the transcript of Twiggy from Fortescue, the speech that he made in regards to how FMG is going to be this sort of pioneer in the renewable energy space, and effectively go up against companies like Tesla that are obviously in that space as well. It's quite clear that there's that sense that even the Australian government will sooner or later sort of move forward with implementing regulation against the coal industry. Until we see that further diversification away from coal, which currently makes up for more than half of their revenues, we really don't like this name at the moment. If you want mining service companies, NWH, MAH, these are names in our universe that we like. It's just that also the mining rental industry or business has longer term issues like maintenance, which will be obviously discounting the share price. And so that's our view on Emeco, but that's sort of the wrap up of this week's webinar. Like I said, this week where we did things a little bit differently, where we focused on that AusBiz interview in hopes that we would sort of focus your attention to some of the media exposure that we have through AusBiz, because our research team work day and night to make sure that when we go up against some of these other advisors, we're a young company. We get it. We haven't been around for decades and decades. And so, we want to make our mark as people who work very, very diligently and ethically, to sustain our business moving forward. And so we thought it'd be a really good opportunity, as we had a fantastic, we think anyway, a fantastic appearance on AusBiz not too long ago, to sort of recap that and hopefully sort of encourage you guys to take a look at the next time we appear. So we generally have a weekly a segment on AusBiz TV or Ticker TV, which are the two major business streaming channels in Australia at the moment. It's the way of the future, guys. Everything's online, so jump on, click on that link on the email that we send in the recording, or that's popping up on the chat window now. But from here, look, appreciate your time. Thank you very much for tuning in, and we'll catch you next week on Wednesday again for our next episode of Macro Minutes. Thanks, guys.